Hello everybody, this is AK. I'm back. So today we're going to look at ST Engineering and also some Chinese banks. And we're going to talk about dividends as well. And okay, long-time readers of my blog would know that I've been an investor in ST Engineering for donkey years, right? And they will be familiar with my story of how I first got invested in ST Engineering at $1.55 a share when I was a young adult, right? And I used like 50% of my monthly pay to buy my first lot of ST Engineering shares. Those days was 1,000 shares per lot and 155 a share, right? And of course, the share price has more than doubled by now, capital gain. But what's more interesting to me was the dividend that they were paying, right? And of course, based on today's dividend payout, I'm looking at yield that's very close to like 10% on cost. And of course, my investment in ST Engineering is free of cost by now, right? And I kept adding to my investment in ST Engineering when I was a young working adult, at 155 I bought, and after that at 180 I bought. And I kept buying, I kept adding to my investments. And it has been very rewarding, right? And ST Engineering to me was a no-brainer, and you can use it as an example because it was sitting on a cash pile, $1 billion cash pile. I didn't know what to do with the money back in those days, and basically every cent that it made, every profit that it made, it just returned to shareholders. So 100% of its earnings were paid out to shareholders. Today we don't see that with ST Engineering anymore. They pay, I think, the last time I read the official guidelines, like they want to pay out 70 to 90% of their earnings to shareholders while retaining some for growth. And these days, ST Engineering really need to retain some of their earnings anyway, because it's a different animal from when I first invested in it donkey years ago. Right, ST Engineering today has a very high gearing level, and in fact, right, is in a net debt position. It's no longer net cash position like when I invested in it so many years ago. It's in a net debt position, about 5.78 billion Singapore dollars, and that equates to a net gearing level of about 236%. 236% net gearing. That is mind-boggling. So a lot of its growth now is debt driven, right? So it borrows a lot of money to invest in new businesses, and that's why it's able to grow more quickly, right? And it doesn't mean that it's going to be in trouble, obviously, because debt can be a good thing, right? When used judiciously, debt can be a good thing. And if we look at ST Engineering, right, the order book has actually grown. The order book has actually grown. It's about up 20%, right? To $27.5 billion year on year. So it is receiving a lot more business. So it's probably able to service its debt. But still, when you have so much debt, right, it is a cause for worry. It's a cause for worry. So would I buy ST Engineering today? Dividend yield of 4.5%. No, I won't. For a simple reason, the pandemic taught me how strong balance sheet is important for businesses, right? And if they have weak balance sheet, we might see dividend getting cut or even suspended when the going gets tough, right? So I won't invest in ST Engineering today, right? But I'm quite okay with holding on to my old investments, which, like I say, those investments that I made back in those days, they are free of cost by now. I'm just getting free money now, right? So what about investing in Bank of China, right? The last I checked, it has like 7.5% dividend yield, right? What about investing in Bank of China? Is the dividend safe? Right? So I have very big investments or at least my investments in the local banks, DBS, OCBC, and UOB, form a substantial part of my portfolio. All right, 30+%, not quite 40%, 30+%. Some people have asked me before, why don't you go and invest in Chinese banks? Because their dividends are very much higher, like 7 point something percent, 8% kind of dividend yield. Well, I mean, it's not much higher than OCBC, for example, which pays 6%, 6.1% dividend yield. So for that 1% or 2% more, I think it's pretty risky. And I keep saying that, of course, some people don't like to hear this because they are invested in Chinese banks for the dividend. And you also have to worry about the foreign exchange risk, because if the renminbi weakens against the Sing dollar, which it has done, then you're going to get a lot less, right? We live in Singapore, we spend Singapore dollar. Right. So, and the latest news I saw is that Chinese bank seems to be having they seem to be doing a mini bond thing of their own. If you some of us remember the Lehman Brothers mini bond saga, and how people bought the mini bonds, lost everything, right? So now the Chinese banks are actually packaging more of their non-performing loans as asset-backed securities. Right, and this has to do with, of course, the country's property debt crisis, right? And this asset-backed securities bond sales jumped 88%, right? And this is mostly done by the state-owned banks, and the state-owned banks actually, they are the China Construction Bank, the big four banks: China Construction Bank, Industrial and Commercial Bank of China, Bank of China, and Agricultural Bank of China, and they were the top issuers of ABS bonds, or asset-backed securities bonds. And these are basically a packaging of their non-performing loans. Yeah. So even though the banks have been cutting back on lending because the economy has been sluggish, it has not done much to stem the piling up of bad loans, which they need to dispose of. All right. The Chinese banks' non-performing loans actually rose by quite a lot, by 183 billion yuan, or renminbi, and it is now about 4 trillion yuan. The Chinese banks are sitting about 4 trillion yuan of bad loans as of the third quarter. That's a lot, right? You know, in a recent video, I said OCBC's NPL, non-performing loans, has actually dropped back to pre-pandemic levels. It has not increased because they have very limited exposure to the Chinese troubled Chinese property sector. So I wouldn't want to take that risk, which I think is unnecessary, and that's investing in Chinese banks for a little bit more dividend payout. And of course, it's in a depreciating currency as well against the Sing dollar, right? So answer to the question on screen: ST Engineering 4.5% dividend yield, or Bank of China 7.5% dividend yield. It's a no for me, right? But it's just me. If AK can talk to himself, so can you. Bye bye.